Want your money to work harder every single year, like all the time, without you lifting a finger or even thinking about it, even in downturns? Well, dividend growth investing is the secret sauce behind steady income and long-term wealth. So let's break down how dividends build up your portfolio almost in stealth mode year after year. So dividend growth investing is simple. You invest in companies that not only pay dividends, of course, but also increase those payouts on a regular basis. So you can think of it as getting a raise from your investments year after year. Here's what that looks like in action. This is a chart showing Johnson & Johnson's consistent yearly payouts. You can see how the dividend just keeps rising. So why is this a classic example? First, 64 years of consecutive dividend increases. That means very stable and predictable payout growth through all kinds of market and economic cycles, right? Think about what's happened over the past 64 years, right? And a widely recognized brand, which is an extra trust factor for investors, particularly the big institutions who are the ones who drive prices higher and drive most of the buying volume. Think of it this way. You buy a stock paying $1 a share today. If the company grows its dividends 6% a year, in 10 years, you're earning $1.79 a share. Now that's approaching double your original income stream just by staying invested. Now with dividend stocks, staying invested is a whole different thing than trading fast growth movers like CrowdStrike or Palantir. Now, as I'm recording this, these are both excellent growth stocks, and their charts are more exciting than J&J. But that's the point. Dividend investing is not supposed to be exciting. Think of your dividend stocks as longer-term holdings. That doesn't mean you never sell, because on occasion you do, of course, but this is not your trading portfolio. So why does dividend growth matter? 3 big reasons, really. First, it's income you can count on. Second, there is capital appreciation because companies that raise their dividends usually are growing their earnings and over time their stock prices too, although that price growth is usually at a slower rate than growth stocks, but that's okay because it can reduce your risk. Third reason, inflation protection. Rising dividends help keep your income growing even as the cost of living goes up, and that's something that's been kind of important lately. For example, dividend kings and aristocrats. These are companies that have raised their dividends for 25, 50, even 60 years in a row. So that shows you they can deliver in good times and bad, which of course we've seen plenty of. Companies like Johnson & Johnson, of course, but also Procter Gamble. You see the dividend increases here. Coca-Cola, same thing. So you get it. Dividend growth investing is not flashy, but it's dependable. Over time, those growing payouts add up to some serious income and wealth, generating a return for you even in a market downturn. Hey, if you want more ETF tips for your retirement portfolio, here's my free guide to ETF income generation. Now, the idea here is to build a strong, diversified retirement portfolio with the right inputs, okay? And that's why I've put together this ETF guide to help you grow and protect your money. From dividend growth and low volatility ETFs to international exposure and inflation hedges, this guide covers it all for you. So whether you're looking for steady income or long-term growth, these ETFs can support your retirement goals. So if you're ready to level up your portfolio, check out the full guide. Link is in the description.